You hear the words private bank and something happens in your chest. Some small ignition. You picture a mahogany desk, a man in a bespoke suit sliding a leather portfolio across it, a conversation about generational wealth held in a room with no visible price tags. You picture old money explaining itself to older money, and somewhere in that picture, you picture yourself. On the right side of the desk this time. Here's what nobody tells you before you start building it. The mahogany desk isn't the business, it's the costume. The actual business, the one that generates the fees, compounds the trust, and eventually prints the kind of numbers that let you build something real, looks nothing like that room. It looks like a spreadsheet open at midnight, a compliance checklist you printed off a regulatory website, a phone call with a custodian who doesn't know your name yet. The private banking aesthetic is Priya's staged barn. The infrastructure underneath it is something else entirely. That's the gap between what clients think you do and what you actually have to build first. And the distance between those two things is where most people quit. So let's talk about what you're actually building and what lane you're getting into legally before you talk to a single client. There are 4 structures most people confuse: a private bank, a registered investment advisor, a broker-dealer, and a fintech platform. A private bank has a charter, regulatory capital requirements, and years of approval process that will eat you alive before you've made your first dollar. A broker-dealer sells securities products and answers to FINRA, which means compliance costs that scale faster than your revenue at the early stage. A fintech sits on top of partner banks and moves fast, but takes years to build trust and often longer to build margins. The RI, the registered investment advisor, is where you start. It's the simplest legal lane, the lowest barrier to entry that still lets you charge advisory fees, manage money with discretion, and build the kind of client relationship that looks and feels like private banking without needing a charter to do it. You register with your state regulator if you're managing under $100 million, move to SEC registration as you scale. That's the lane. Everything else comes later. But the lane alone doesn't tell you where to drive. The second decision matters more than most people realize. You need a niche with asymmetric trust. Not a wide market, a specific one. Founders who just closed a Series B and have no idea what to do with liquidity. Physicians who generate high income and almost universally underestimate their tax exposure. Real estate operators who are asset-rich and cash flow complex and need someone who speaks their language. Athletes sitting on rookie contracts that expire in 4 years. Each of these groups has a trust problem. They've been sold to by product people who disguise themselves as advisors. They've been burned or watched someone close to them get burned. That wound is your door. Your single flagship offer should solve one specific version of their pain so precisely that they don't need to understand your credentials. They just need to feel seen. A cash flow clarity system for physicians. A liquidity event playbook for founders. One offer. Specific language. One kind of client. You don't serve everyone in year 1. You serve the group you understand better than any generalist ever could. Which brings you to the problem of starting from zero credibility. Because you can have the right niche and the right offer and still be invisible. Credibility at this stage is not about your resume. It's about proof of work. Write the analysis nobody asked you to write. Break down a real estate operator's capital stack in public and let the right people see your thinking. Build an underwriting mindset into everything you produce, which means you're not just offering opinions, you're showing your work, your assumptions, your risk framework. Then you borrow other people's trust. A custodian relationship with Schwab or Fidelity or altruist signals to clients that someone with compliance infrastructure has already vetted you enough to hold their assets. A referral partnership with a CPA or estate attorney whose clients already trust them moves that trust sideways onto you. You're not manufacturing credibility from nothing. You're engineering a chain of it until yours is established enough to stand alone. Your first 10 to 50 clients will define the next decade faster than any marketing campaign you run. The onboarding process needs to be cleaner than anything they've experienced with a larger institution. KYC and AML are not optional niceties, they're legal requirements, and getting them wrong early creates liability that can end the whole project. Know your customer means verifying identity, source of funds, and financial picture before a dollar moves. Anti-money laundering means you have documented policies and you follow them, not because you expect crime but because the regulator who audits you later will check whether you acted like you did. Build the referral engine from day one by designing the onboarding experience to produce one specific outcome, a client who tells exactly one person about you before the first quarter ends. That's not a wish, that's a service design problem. The economics at the ground floor are simple and brutal. 1% of assets under management annually is the standard advisory fee, though you can charge more for complexity and comprehensive planning services. Your cost to acquire a client through referral is low but slow. Your lifetime value on a client with $2 million under management is $20,000 a year before expenses. The math only works if your capacity scales faster than your headcount. That means your first tools are not employees. They're a CRM, a financial planning platform, a portfolio reporting system that makes you look like you have a team before you have a team. But there are tripwires sitting in this field that will end you quietly. Compliance boundaries are not suggestions. You cannot take custody of client assets without triggering a different regulatory framework. You cannot accept commissions if you're operating as a fee-only RIA without restructuring your model. You cannot recommend products in which you have an undisclosed financial interest. These are not bureaucratic inconveniences. They are the exact places where early builders cut corners and the exact places where regulators and client lawsuits eventually find them. The mahogany desk is real, but it's built on top of something that looks nothing like it. The people who make it to the desk are the ones who understood the infrastructure underneath it first, who chose the right legal lane, found the right niche, borrowed trust until they built their own, and never once confused the costume for the business. You're not starting a brand, you're tipping the first domino. The first domino is down. You have clients, you have fees coming in. You have a niche tight enough to actually mean something. And then one morning you're sitting across from a client who just wired $3.8 million into the custodial account, and you realize, with a clarity that arrives the way cold water does, that you have built something real enough to lose. That's the threshold. Most people feel it before they can name it. The moment the business gets serious enough that the gaps in your infrastructure stop being inconveniences and start being liabilities. So you go back to the blueprint. Not the one with the mahogany desk on it. The other one. Formal compliance is not the thing you build when the regulator asks for it. It's the thing you build so that when the regulator asks for it, they find a system that's been running, not a stack of paper you assembled the week before. A compliance manual, a written supervisory procedures document, a code of ethics, a conflicts of interest policy. These are not documents you download from a template site and sign. They're the operating logic of the business made visible, and they need to match what you actually do, not what you plan to do in year one. The gap between those two things is where audits find you. Get a compliance consultant who has sat on the regulator's side of the table. That investment pays for itself the first time a prospective client asks to see your ADV Part 2 and you hand it to them without hesitating. Custodian selection is an infrastructure decision disguised as a vendor decision. Schwab, Fidelity, Altruist. The name on the custodian relationship signals something to every sophisticated client who checks, and they all check. But beyond the signal, the operational reality matters just as much. What does their reporting interface look like? Can you white label it? What's the data feed into your portfolio management system? How fast do they resolve problems when something breaks at 4:45 on a Friday? You are building a service business on top of their rails. The quality of those rails determines whether your client experience holds together at 2 a.m., when someone's wiring instructions aren't processing and they're leaving for Europe in 6 hours. Cybersecurity is the compliance conversation that nobody wants to have until they're having the worst version of it. At this level, you are holding financial data on people with meaningful net worth. You are a target with a smaller security team than a regional bank. Two-factor authentication, encrypted communication channels, documented incident response procedures, and a cyber liability insurance policy are not optional features of a serious firm. They are the price of operating without catastrophic exposure. Record keeping and audit readiness are the same muscle. If you can't reconstruct every client interaction, every recommendation, every fee charge in a clean paper trail, you don't have a compliant business. You have a business that hasn't been examined yet. Now, the product ladder, because compliance is what keeps you in business, but the product stack is what makes the business worth keeping. At this level, the progression is real, but it has to be sequenced correctly. Core investment advisory is your foundation. It's what you're registered to do, it's what generates your AUM-based fee, and it's where your relationship lives. The temptation is to jump past it toward the interesting stuff too fast. Don't. Earn the complexity. Once you've demonstrated that you can manage a portfolio through a volatile quarter without your client calling you in a panic because you hadn't prepared them, you've built the credibility to introduce the next layer. Lending introductions come next. Clients with meaningful assets need liquidity without triggering tax events. Securities-backed lending, portfolio lines of credit, commercial real estate bridge financing. You're not the lender, you're the architect who understands the client's balance sheet well enough to know which tool fits and which institution to place it with. That's the credit brain. Private banks don't just invest. They underwrite. They think about collateral concentration risk, liquidity coverage ratios, and what happens to the loan structure if the underlying asset drops 30%. You need to think this way before you make a single lending introduction, because the client who trusts you with their investment portfolio and then ends up in a margin call they didn't understand is a client who will never forgive you and shouldn't. Structured solutions and alternatives come after that. And at $50 million, they look more like access than manufacturing. A private credit fund where a manager relationship gives your clients a quality allocation. A real estate co-investment alongside an operator you've diligenced. The ability to say yes to a category the wirehouses say no to is its own form of value, as long as the diligence underneath the yes is real. Talent comes before you think you can afford it and later than you want it to arrive. The first hire is almost always the wrong hire if you're hiring a relationship manager before you have a compliance function. The operations and compliance infrastructure has to carry weight before the distribution function adds more. Incentives need to be structured so that your relationship managers are rewarded for retention as much as acquisition. A client who stays for 12 years is worth more than 3 clients who leave in 2. That math should be visible in how you pay people. Distribution at this level is not advertising, it's ecosystem design. CPAs and estate attorneys are your highest leverage referral channels because their clients already trust them with sensitive information. A single CPA who does tax work for 14 high-income physicians can introduce you to more qualified clients in a year than any content campaign you run. You earn that relationship by being useful to them first, by showing your thinking on a case that already landed on their desk, by making their client's financial picture cleaner without making the CPA feel bypassed. The unit economics that matter here are simple: revenue per client, capacity per advisor, and churn. If your churn rate is above 5% annually, something in the service model is broken. If your revenue per client isn't rising as the relationship ages, you're not deepening the relationship. You're just maintaining it. Maintenance is a slow leak. The business that makes it to $200 million isn't the one that had the most clients at $50 million. It's the one that built the infrastructure first and let the clients fill it. You made it to $50 million in AUM the same way Ellery made it to wherever he is. Quietly, deliberately, without announcing the milestone to anyone who didn't need to know. And now the question sitting across from you every morning isn't whether the business works. It's whether the business can become something bigger than the version of you that built it. That's a different question. Most people don't realize that until they're already answering it wrong. The pivot that defines this phase isn't a product decision. It's a philosophical one. You're deciding whether you're in the advice business or the balance sheet business. Advice businesses scale to a ceiling determined by how many hours you have. Balance sheet businesses scale to a ceiling determined by how much capital you can intelligently deploy and how much risk you can intelligently bear. The ceiling on the second one is orders of magnitude higher. But so is the wreckage if you miscalculate. Lending capability is where that choice becomes concrete. You either build it or you partner for it. Building means warehouse lines, regulatory capital treatment, loan origination infrastructure, and a credit team that thinks in terms of loss given default before they think in terms of yield. Partnering means bank relationships, referral agreements, co-lending structures, and the intellectual humility to know that the margin you leave on the table is the price of not blowing up a client relationship because you underwrote something you didn't fully understand yet. At $200 million, most serious operators partner first and build later. The terms of those partnerships matter more than the headline rate. Who has recourse? Who holds the residual risk? What happens to the client's loan structure if the underlying collateral moves against them by 30% in 90 days? Those are not hypotheticals. They are the stress test you run before you place a single dollar. Capital sources for the alternatives layer follow the same logic. Warehouse lines give you deployment capacity, but carry their own covenants and usage restrictions. Bank partnerships offer distribution infrastructure, but come with product shelf preferences that may not match your client's actual needs. Securitization pathways exist for firms that have moved past the boutique stage entirely, but the moment you start thinking about securitization, you need legal counsel whose entire practice is structured finance, not a generalist who's read the statute. The thing about headline numbers in private finance is that they always sound better than the terms that govern them. Read the terms, especially the ones on the pages nobody flags for you. Proprietary deal flow is how you stop being a distributor and start being an originator. Real estate co-investments alongside operators you've diligenced yourself. Private credit opportunities sourced through relationships your client's money helped build. Venture access structured not as a FOMO play but as a deliberate, size-appropriate allocation to asymmetric upside for clients whose liquidity can tolerate a 7-year lockup. The filter that determines which deals reach your clients is the thing that protects your brand over time. Say no to more than you say yes to, not because scarcity is a marketing tactic, but because the deals that hurt clients always looked fine on a term sheet until they didn't. The reputation you build by declining 3 mediocre deals is worth more than the fee income from closing them. Risk management at this scale is not a spreadsheet you review quarterly. It's a living system with teeth, concentration limits, duration and liquidity mismatch monitoring, Stress tests that model what happens to a client's total picture, not just the portion you manage. If credit spreads widen by 200 basis points while their real estate portfolio needs a capital call and their portfolio line gets marked. Drawdown playbooks that your team runs from memory because they've practiced them, not because they're reading instructions in a crisis. The firms that fail at this stage don't fail because they picked the wrong investment. They fail because they never modeled what three things going wrong simultaneously would look like. That scenario always sounds unlikely until it happens. Then it sounds like exactly what should have been anticipated. Regulatory and legal complexity expands in direct proportion to your capability set. Multiple entity structures become necessary when you're operating an advisory business alongside a lending function alongside an alternatives platform. Each entity needs its own capitalization logic, its own disclosures, its own regulatory relationship. Marketing rules for private placements and alternative investments are specific, enforced, and unforgiving. Suitability documentation that was adequate at $50 million in AUM becomes inadequate the moment you're recommending illiquid alternatives to a client whose liquidity needs you didn't model carefully enough. The legal infrastructure that keeps the business fundable, that keeps your institutional partners willing to sit across from you, that keeps the regulator finding a system rather than a gap, that infrastructure is the moat. Not the one people talk about, but the one that actually holds. Brand positioning at this level is a tension management problem. Moving up market without abandoning the clients whose trust funded your credibility. The white glove experience that actually scales is built on systems, not heroics. It's the intake process that makes a new client feel like they're the only person in the building even though your team runs it for every onboarding. It's the quarterly review that communicates in plain language even when the underlying portfolio construction is genuinely sophisticated. It's the fact that when a client calls on a Friday afternoon with a question that has nothing to do with their portfolio, someone picks up who knows their name and their situation without putting them on hold to look it up. That experience is engineered. It's not personality. It's process. Client segmentation stops being optional at $200 million. You have clients who need active, high-touch advisory contact because their financial lives are genuinely complex and changing. You have clients whose situations have stabilized and who need responsive stewardship more than constant engagement. You have clients in between. Treating those three groups identically is expensive and inefficient, and more importantly, it means the complex clients aren't getting what they're paying for, and the stable clients are getting contacted more than they want to be. Service tiers clarify the value exchange. Automation handles the communication cadence, so your advisors are spending time on judgment, not scheduling. Playbooks govern everything that needs to happen without requiring a senior decision. They're not scripts. They're the institutional memory of every problem the business has already solved, written down so it doesn't have to be solved again from scratch at the worst possible moment. At $200 million, the business that survives is not the most charismatic one. It's the one where the founder could disappear for 6 weeks and the clients would never know because the system is the thing they hired, not just the person who built it. Ellery doesn't manage his money every day. He built something that runs when he's reusing his coffee grounds. That's the point. At $500 million, the question isn't whether the business is real. It's whether you want to become something else entirely or whether you want to own your niche so completely that nobody else can touch it. Those are genuinely different endgames. Most people building toward this number haven't decided which one they're actually chasing. And the decision you make, or the one you fail to make deliberately, will determine everything about what the next decade costs you. The first path is dominance without a charter. You stay independent, non-bank, deeply specialized in the client segment you've spent years understanding better than anyone else. Family offices with operating businesses, physicians with complex deferred comp, real estate operators who need sophisticated cash management alongside their acquisition activity. Whatever the niche is, you go deeper instead of wider. The ceiling on this path is lower in headline AUM terms, but the margin structure and the client retention rates at the top of a well-owned niche are things most platform businesses would trade everything for. You become Ellery's money manager, not the one with the biggest lobby. The second path is acquiring a charter or buying a regulated bank. When you do this correctly, you unlock deposit taking, lending authority, and payment rails that transform the economics of every relationship you already have. When you do this incorrectly, you've bought a compliance burden, a legacy core system that hasn't been updated since a prior administration, and a loan book with 3 problems the seller priced into the discount and 4 more they didn't mention. Due diligence on a bank acquisition is not the same as due diligence on a business. You are buying a regulatory relationship. You are buying every decision someone else's loan committee made for the last 10 years. Hire the examiner who left the relevant regulator 18 months ago. They will find things your investment banker will not. The third path is merging into a larger platform. You get capital, distribution, and a liquidity event. You lose control of the client experience, the culture you've spent years encoding, and often the team that made the first two worth anything. The earnout structures in these deals are designed by people whose incentive is to make the number look achievable while building in the conditions that make it nearly impossible to hit. Read the integration covenants the same way you read the loan terms nobody flags, especially the ones about client consent, AUM retention thresholds, and what happens if two of your senior advisors leave in the first 18 months. M&A strategy at this stage means buying books, teams, or technology rails. Books come with client relationships that are actually relationships with the advisor who's leaving, not with your platform. The retention math on an acquired book without the originating advisor is brutal. Teams are harder to integrate and more valuable when you succeed because the cultural fit determines whether the talent stays past the lockup. Technology and fintech rails are the acquisition class most people underestimate. Buying a well-built lending infrastructure or a clean compliance platform is often worth more than buying a client list, because infrastructure compounds and client lists decay. Governance at this scale is not optional and not theoretical. A risk committee that actually meets, actually models stress scenarios, and actually has the authority to say no to revenue-generating activity that creates tail risk, that structure is the thing standing between you and the moment your name appears in a headline you never imagined. Board advisors who have operated at the scale above yours will see the thing you can't see yet, because you're still inside it. Institutional grade reporting, the kind your largest clients and any potential capital partner would review without finding gaps, is the evidence you produce that the business is a system and not a person. Client protection at this level requires liquidity planning that runs a layer below the investment conversation. Where's the cash if three of your largest clients have simultaneous capital needs? What is your counterparty exposure on the lending side if the bank you've partnered with changes its credit appetite? Fraud prevention is not a technology purchase. It is a documented escalation protocol that your entire team has practiced, including the scenario where the fraudulent instruction comes from an email address that looks exactly like the client's. Reputational crisis drills are the thing every firm postpones until they need them. Then they run them in real time with journalists on hold. The private bank flywheel, the actual engine that makes this whole structure durable, is deposits and cash management feeding lending. Lending feeding investment relationships feeding advice, and advice deepening the deposit relationship. Each element makes the others harder to leave. A client who has their operating cash, their line of credit, their investment portfolio, and their tax and estate strategy running through a single relationship you manage is not a client. They are a structure, and structures are significantly harder to move than accounts. Your own wealth strategy inside this is a separate problem that most founders answer wrong. The equity in the business is not the same as money. It is an illiquid position in a firm whose value is correlated to your continued presence and to market conditions you don't control. Paying yourself in cash flow throughout the build is not a sign that the business is struggling. It is how you avoid being paper rich in an entity that requires every dollar to stay inside it until someone buys it. Diversification outside the business is not a lack of conviction. It is what Ellery would call a basic arithmetic decision. Your entire financial life should not be one asset, even if that asset is the thing you built with your own hands. Here is the principle that governs all of it, from the first 10,000 client to the $500 million platform. The business that survives is the one nobody can hold hostage. Not a single client, not a single regulator, not a single market condition, and not the founder's need for the world to know what they've built. Ellery never told you what he had, he just kept having it. That's the architecture, that's the whole thing. If you're building any piece of this right now, drop in the comments which level you're at. If this gave you something you can use today, the like and subscribe buttons are right there. And they cost you nothing, unlike the coat.